the earliest warning signs rarely arrive with headlines. They surface instead in the slow drift of financial behavior. In late-night sessions on Wall Street, traders notice dollar liquidity tightening, swap lines becoming more expensive, cross-currency basis spreads inching wider. Foreign central banks, once reliable buyers of U.S. debt, begin trimming their holdings, echoing patterns seen before Argentina's 2001 collapse and Greece's 2010 credit freeze. At first, the movement seemed technical, even forgettable. But taken together, they hint at a subtle shift in confidence. Mortgage rates climb despite no major policy change, while short-term funding markets grow unusually sensitive to minor shocks. Analysts publish quiet reports warning that if the dollar faces a sudden loss of trust, even a temporary one, the effects could ripple far faster than policymakers expect. History suggests that crises rarely start with chaos, they start with hesitation. A currency shock does not appear instantly. It builds through interconnected mechanisms that gradually tighten around the financial system. As the dollar weakens, import prices rise first. Energy, raw materials, essential goods, pushing inflation higher even as consumer demand softens. Bond yields begin climbing as investors demand greater compensation for perceived risk, pressuring federal borrowing costs and corporate debt markets simultaneously. Banks, sensing volatility, pull back on lending. Liquidity thins across repo markets, reminiscent of the freeze that preceded the 2008 meltdown. For global investors, the feedback loop becomes dangerous. A softer dollar fuels higher inflation prompts fears of additional rate hikes, and those fears ignite further sell-offs in U.S. assets. Like Turkey during its 2018 currency spiral or Venezuela's cascading devaluation, the mechanics follow a familiar pattern. Confidence erodes first, stability second, and purchasing power last. When the system begins to unwind, the shock moves with mathematical precision, not emotion. To understand the fragility of a currency under pressure, comparisons beyond U.S. borders offer sobering lessons. In Argentina, repeated devaluations were triggered not by a single event, but by a long erosion of trust. Each dip in bond demand accelerating inflation that ordinary families could not escape. Greece's 2010 debt crisis showed how quickly markets can turn when sovereign risk is questioned, pushing bond yields into levels that make government financing nearly impossible. Even Turkey's rapid depreciation in 2018 revealed how geopolitical tension and high external debt can ignite a spiral in mere weeks. While the U.S. remains far more resilient, globally integrated systems behave similarly when confidence weakens. Foreign investors retreat, central banks diversify reserves away from the dominant currency, and capital outflows amplify volatility. These comparisons highlight an uncomfortable truth. No nation, however large, is immune to the force of global sentiment. When confidence in the dollar weakens, the impact on the U.S. economy reaches far beyond financial charts. Rising import costs filter quickly into everyday prices: fuel, groceries, electronics, tightening household budgets already strained by elevated mortgage rates. Corporations with overseas supply chains face higher expenses, cutting hiring plans and delaying investments. U.S. bond yields, pushed upward by foreign selling, raise borrowing costs for everything from credit cards to auto loans. Even states and municipalities feel the pressure, paying more to fund infrastructure and public services. In this environment, small businesses struggle most. Thinner margins and shrinking credit availability echo the difficulties seen during the early months of the Great Depression and again in 2008. Meanwhile, export industries gain temporary relief from a weaker dollar, but not enough to offset broader economic drag. As volatility grows, the underlying worry becomes clear. A currency shock doesn't just move markets, it reshapes the daily reality of millions of Americans. As the pressure builds, attention inevitably turns to Washington and the Federal Reserve. Policymakers confront a dilemma with no easy choices. Raising interest rates could stabilize the dollar by attracting capital back into U.S. assets, but it risks choking an economy already slowing under high borrowing costs. Cutting rates, on the other hand, might support growth but deepen doubts about the currency's strength. In times of stress, the Fed may reopen dollar swap lines with key allies, echoing the emergency measures used during the 2008 crisis and the 2020 pandemic liquidity crunch. The Treasury considers interventions in foreign exchange markets, though history shows such actions offer only temporary relief unless confidence fundamentally improves. Congressional debates over the debt ceiling add another layer of uncertainty, with each standoff sending tremors through global bond markets. The response becomes a balancing act. Stabilize markets without signaling panic, preserve credibility without triggering deeper economic pain. For ordinary Americans, the question becomes practical. What can individuals do when a currency shock threatens the stability of their daily lives? History offers guidance. During the 1970s inflation surge, households that diversified their savings, splitting between cash, short-term treasuries, and tangible assets, weathered volatility more effectively. In the 2008 crisis, families with emergency funds avoided the worst consequences of sudden layoffs and credit freezes. Today, similar strategies apply. Maintaining liquidity is essential. In times of financial stress, access to cash can matter more than investment returns. Avoiding excessive variable rate debt helps protect against sudden jumps in interest payments. Some turn to inflation-shielded instruments like TIPS, while others focus on essentials, reducing discretionary expenses, building modest reserves of staple goods, and strengthening job skills in resilient sectors. These steps cannot eliminate risk, but they provide a measure of stability when the value of the dollar and the predictability of the economy comes under pressure. If the dollar falters, the emotional toll may be less visible than price tags or interest rates, yet just as profound. Economic shocks erode a sense of certainty that Americans have long taken for granted. The assumption that the currency in their wallets will hold its value, that savings will grow steadily, that tomorrow's costs can be reasonably predicted. During past crises, from the Great Depression to the 2008 collapse, it wasn't only the financial damage that lingered, but the shift in collective psychology. Families postponed dreams, businesses delayed expansion, and communities rebuilt trust slowly, year by year. A currency shock would demand similar resilience. Still, history also shows that recovery is possible when institutions adapt, when citizens stay informed, and when difficult realities are met with clear-eyed resolve. As we continue this journey, the question remains. In a world where stability is no longer guaranteed, how does a nation find its footing again? As global markets react to the weakening dollar, an intricate web of international relationships begins to shift. Trading partners adjust their currency reserves, diversifying into euros, yen, or even commodities as a hedge against American volatility. Multinational corporations recalculate their earnings forecasts, wary of exchange rate swings that can erase profits overnight. In regions already skeptical of U.S. dominance, such as parts of Asia and the Middle East, policymakers explore alternative payment systems, steps reminiscent of the gradual de-dollarization efforts that accelerated after the 2008 crisis. Even allies, while still reliant on U.S. stability, quietly plan for scenarios where treasuries no longer serve as the world's unquestioned anchor asset. These changes unfold slowly at first, then with growing momentum, capturing the world's attention. The financial landscape begins to feel different, less predictable, more contested, and increasingly shaped by nations preparing for a world where the dollar's supremacy can no longer be assumed. As the ripple effects intensify, the strain becomes visible within America's internal financial structure. Regional banks, already cautious after recent liquidity scares, tighten lending standards further, echoing patterns seen before the 2008 credit crunch. Bond markets grow volatile as 10-year Treasury yields climb, forcing pension funds, insurers, and retirement portfolios to reassess their risk exposure. The commercial real estate sector, sensitive to financing costs, faces renewed pressure, amplifying concerns about vacant offices and refinancing cliffs. Meanwhile, consumers encounter the stress more directly. Higher credit card APRs, shrinking loan approvals, and rising costs for essential services tied to energy and transportation imports. In this environment, volatility becomes a kind of background noise, persistent and unsettling. Even routine economic updates, CPI readings, payroll numbers, liquidity reports, take on outsized importance. With each new data point, markets search for clarity, unsure whether the nation is nearing stabilization or merely entering the next stage of disruption. As the pressure reaches its peak, the question confronting America is no longer whether the dollar can stumble, but how the nation responds when it does. Markets begin searching not for perfection, but for signs of stability, a credible fiscal plan, a clear Federal Reserve roadmap, and a political environment capable of avoiding self-inflicted crises like debt ceiling standoffs. Throughout history, from the 1930s to 2008, recovery has come not from denying vulnerability, but from confronting it openly. Households, businesses, and institutions adapt, reassessing risks and rebuilding confidence step by step. And while a currency shock challenges the core of America's economic identity, it also forces a recalibration, one that can ultimately strengthen long-term resilience. In the end, nations endure not because their currencies never falter, but because they learn to steady themselves when the world feels most uncertain. The path ahead is difficult, but not without direction,